Hello. Okay, I'm back. The title of this stream is Has China Beaten by Neoliberalism? This one is based on an article by Ellen Brown. Yeah, she came up with another good article pretty quickly. And the title of her article is Neoliberalism Has Met Its Match in China. And she published this in Truthdig and also on her own website, The Web of Dead. If she doesn't have it on there now, she will in a couple of days. That's for sure. And it may have appeared elsewhere too, such as in Common Dreams and in Truth Out. Usually her articles will appear in 4 or 5 places. Now, this article is very interesting from the MMT point of view also. So, for those of you who like MMT, you should find some aspects of this article familiar. So let me share the article now. There it is. When the Federal Reserve cut interest rates last week, commentators were asking why. According to official data, the economy was rebounding, unemployment was below 4%, and gross domestic product growth was above 3%. If anything, by the Fed's own reasoning, it should have been raising rates. Market pundits explain that we're in a trade war. Yes, Trump's trade war. And a currency war. Yes, Trump's currency war, too. Other central banks were cutting their rates. And the Fed had to follow suit in order to prevent the dollar from becoming overvalued compared to other currencies. Theory is a cheaper dollar will make American products more attractive in foreign markets, helping our manufacturing and our labor bases. Over the weekend, President Trump followed the rate cuts by threatening to impose on September 1st a new 10% tariff on $300 billion worth of Chinese products. China responded by superseding imports of U.S. agricultural products by state owned companies and letting the values of the yuan drop. On Monday, the Dow Jones Industrial Average dropped nearly 770 points, its worst day in 2019. The war was on, says Ellen. And she goes on, the problem with the currency war is that it is a war without winners. This was demonstrated in the beggar thy neighbor policies of the 1930s, which only deepened the Great Depression. As economist Michael Hudson observed in a June interview with journalist Bonnie Faulkner, um, uh, to make American products cheaper abroad will do little for the American economy because we no longer have a competitive manufacturing base or products to sell. Okay. Today's workers are largely in the service industries, cab drivers, hospital workers, insurance agents, and the like. A cheaper dollar abroad just makes consumer goods at Walmart and imported raw materials for U.S. businesses more expensive. Note, please, that Michael Hudson, okay, is an MMT economist with a twist. He's a Marxist MMT economist and has been for many, many, many years, but he's an unconventional Marxist in many ways. What is mainly devalued when a currency is devalued, Hudson says, is the price of the country's labor and the working conditions of its laborers. The reason American workers cannot compete with foreign workers is not that the dollar is overvalued. It is due to their high costs of housing, education, medical services, and transportation. In competitive countries, these costs are typically subsidized by the government. So that is Hudson's thinking at this point. Uh, these are interesting thoughts. So America's chief competitor in the trade war is obviously China, which subsidizes not just worker costs, but the costs of its businesses. Of course, to subsidize the worker costs runs contrary to neoliberalism to begin with, right? Of course. So anyway, going back to the article, the government owns 80% of the banks, which make loans on favorable terms to domestic businesses, especially state-owned businesses. If the businesses cannot repay the loans, neither the banks nor the businesses are typically put into bankruptcy, since that would mean losing jobs in factories. The non-performing loans are just carried on the books or written off. No private creditors are hurt, since the creditor is the government, and the loans were created on the bank's books in the first place, following standard banking practice globally. What Ellen Brown means by that is that banks in most countries of the world these days have the power to supply deposits in the currency of the particular government in return for loans that are created on the books of the banks in the first place. So the deposits that are created by the banks, are liabilities of the banks, but the loans created by the banks are the assets of the banks. So there's an asset equal to the liability, which is the deposit supplied by the bank to the borrower. Going on, as observed by Jeff Spross in May 2018, in a Reuters article titled, quote, Chinese banks are big, too big, question mark, unquote. And Jeff Spross says, and I'm quoting Jeff Spross now, because the Chinese government owns most of the banks and it prints the currency, it technically keeps those banks alive and lending forever. It may sound weird to say that China's banks will never collapse, no matter how absurd their lending positions get. But banking systems are just about the flow, of money. Spross quoted bank CEO Richard Bavag. I presume he doesn't say his last name, is vague, but maybe he does. Chair of the Governor's Woods Foundation, who explained, quote, China has committed itself to a high level of growth, and growth, very simply, is contingent on financing. Beijing will come in and fix the profitability, fix the capital, fix the bad debt of the state-owned banks, by any number of means that you and I would not see happen in the United States. Unquote. Unquote. Let me hang in here for a second and see that everybody's hearing me okay. Okay, so back to the article. Anyway, political and labor unrest is a major problem in China. Spross wrote that the government keeps everyone happy by keeping economic growth high and spreading the proceeds to the citizenry. Well, that's very different from the neoliberal economic systems, such as the United States and most of the other systems in the Western world. About two-thirds of Chinese debt is owed just by the corporations, which are also largely state-owned. Corporate lending is thus a roundabout form of government-financed industrial policy, a policy financed not through taxes, but through the unique privilege of banks to create money on their books. China thinks this is a better banking model than the private Western system, focused on short term profits for private shareholders. But U.S. policymakers consider China's subsidies to its businesses and workers to be unfair trade practices. They want China to forego state subsidization and its other protectionist policies in order to level the playing field. But Beijing contends that the demanded reforms amount to economic regime change, quote unquote. As Hudson puts it, quote, this is the fight that Trump has against China. He wants to tell it to let the banks run China and have a free market. He says that China has grown rich over the last 50 years by unfair means, with government help and public enterprise. In effect, he wants the Chinese to be as threatened and insecure as American workers. They should get rid of their public transportation. They should get rid of their subsidies. They should let a lot of their companies go bankrupt so that Americans can buy them. They should have the same kind of free market that has wrecked the U.S. economy. Unquote. Kurt Campbell and Jake Sullivan, writing on August 1st in Foreign Affairs, call it an emerging contest of economic models. Actually, what they said, okay, was just a contest of the models. To understand what is happening here, it is useful to review some history. The free market model hollowed out America's manufacturing base beginning in the Thatcher-Reagan era of the 1970s and 80s, when neoliberal economic policies took hold. Meanwhile, the emerging Asian economies, led by Japan, exploding on the scene with a new economic model called state guided market capitalism. Unquote. The state determined the priorities and commissioned the work, then hired private enterprise to carry it out. The model overcame the defects of the communist system, which put ownership and control in the hands of the state. The Japanese state-guided market system was effective and efficient, so effective it was regarded as an existential threat to the neoliberal model of debt-based money and free markets as promoted by the IMF, the International Monetary Fund. According to author William Engdahl in A Century of War, by the end of the 1980s, Japan was considered the leading economic and banking power in the world. Its state-guarded model was also proving to be highly successful in South Korea and the other Asian tiger economies. When the Soviet Union collapsed at the end of the Cold War, Japan proposed its model to the former communist countries, and many began looking to it and to South Korea's example as viable alternatives to the U.S. Free market system. State guarded capitalism actually provided for the general welfare without destroying capitalist incentive. Engdahl wrote, tiger economies were a major embarrassment to the IMF free market model. The very success in blending private enterprise with a strong state economic role was a threat to the IMF. So long as the tigers appear to succeed with a model based on a strong state role, the former communist state and others could argue against taking the extreme uh, 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 the the extreme IMF course. Sorry about that. Course, the IMF course was the neoliberal course, and in general is a course of getting rich through austerity. In East Asia during the 1980s, economic growth rates of 7 to 8% per year, rising Social Security, universal education, and a high worker productivity were all backed by state guidance and planning, albeit in a market economy. An Asian form of um, 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 an Asian form of um, 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 benevolent paternalism. Sorry about that. Just as the U.S. had engaged in the Cold War to destroy the Soviet communist model, so Western financial interests set out to destroy this emerging Asian threat. It was diffused when the neoliberal economists in the West persuaded Japan and the Asian tigers to adopt a free market system and open their economies and companies to foreign investors. Western speculators then took down the vulnerable countries one by one in the Asian crisis of 1997 to 98. China alone was left as an economic threat to the Western neoliberal model. And it is this existential threat that is the target of the trade and currency wars today. Interesting point of view, isn't it, friends? In their August 1 Foreign Affairs article entitled Competition Without Catastrophe, Campbell and Sullivan write that the temptation is to compare these economic trade wars with the Cold War with Russia, but the analogy is not apt. Quote, China today is a peer competitor that is more formidable economically, more sophisticated diplomatically, and more flexible ideologically than the Soviet Union ever was. And unlike the Soviet Union, China is deeply integrated into the world and intertwined with the U.S. economy. Unlike the Soviet communist system, the Chinese system cannot be expected to crumble under its own weight. The U.S. cannot expect and should not even want to destroy China, Campbell and Sullivan say. Rather, we should aim for a state of coexistence on terms favorable to U.S. interests and values, unquote. The implication is that China, being too strong to be knocked out of the game as the Soviet Union was, needs to be coerced or cajoled into adopting the neoliberal model and abandoning state support of its industries and ownership of its banks. But the Chinese system, while obviously not perfect, has an impressive track record for sustaining long term growth and development while the manufacturing base of the U.S. was being hollowed out under the free market model. Why? Because the free market model allowed the capitalists to leave the United States and bring their manufacturing to China, okay, and to other nations, and then to sell the goods back into the United States to exploit the market here in the United States for profits and really basically as a tool for extracting the wealth of the majority of people in the United States. That extraction has been going on for years and years. And of course, the profits have been flowing into the tills of the very large corporations who manufacture overseas and then export the products back to the United States. China was systematically building up its own manufacturing base and investing heavily in infrastructure and emerging technologies. And it was doing this with credit generated by its state owned banks. Rather than trying to destroy China's economic system, it might be more favorable to U.S. interests and values for us to adopt its more effective industrial and banking practices. We cannot win a currency war through the use of competitive currency devaluations that trigger a race to the bottom. And we cannot win a trade war by installing competitive trade barriers that simply cut us off from the benefits of a cooperative trade. More favorable to our interests and values than warring with our trading partners would be to cooperate in sharing solutions, including banking and credit solutions. The Chinese have proven the effectiveness of their public banking system in supporting their industries and their workers, rather than seeing it as an existential threat. We could thank them for test driving the model and take a spin in it ourselves. So, what are the implications of this article? One leading implication, and a very important one, is that Ellen Brown is advocating for the United States to nationalize a good part of our banking system, not necessarily to centralize a good part, okay, of the banking system, but to 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 nevertheless create a system, okay, of publicly owned banks, okay, across the United States, so that the profits that flow to the banks would also flow back to the public. And of course, this is justified because uh, the capability of banks to create loans on its books and to create the money as it creates those loans is a capability, is a power that is derived from the central government and from the ability of the central bank to back up each of the individual banks in the banking system and prevent these banks from going into bankruptcy or from running out, okay, of money. So of course, the first step in allowing a system like this to operate is to make most of the banks in such a system banks that are public. And the reason why is that if investments that are bad investments, okay, are made, the losses to the banks in that system would simply be paper losses and would not affect the capability of those banks to, to continue to create money in the process, okay, of actually making loans to businesses. Thus, the great expansion of businesses can be facilitated as it has been in China. Also, the types of loans that are created can be created in line with the industrial policy of the government. And of course, we call it the industrial policy of the government. But these days, it would be the policies of the government that are designed to transform the economy and to create a sustainable economy that can counter climate change. So, network public banks would really be perfect for that. And it's perfectly possible for us to implement here, okay, in this country. Now, fiscal policy can still be used for all kinds, okay, of purposes, and the government can create money to implement, okay, its fiscal policy. And when inflation actually threatens, it can drain off the excess money in by various ways, through taxation, but also through selling bonds. Okay, if it has to sell bonds, of course, we would want to promote the absolutely true idea that when the government is selling bonds to the private sector, that uh, it is not actually contracting debt in the way that you and I contract debt. Of course, it would have to pay back the principal, it would have to pay back the interest, but the meaning of the bank instruments is not the same for the government. I should say the debt instruments is not the same for the government as the meaning of the debt instruments is for us. We are private, of course. We can go bankrupt, and therefore uh, it is sometimes very, very painful for us to repay, okay, our debts. But for a government that can create its own currency and that does not borrow in any foreign currency, it can always create the credits it needs to repay the bank instruments that it has issued in order to cool an overheated economy. Okay, so that is a very important article, I think, by Ellen Brown, and that is also my commentary on it. So I'm now going to end the stream. I will look at your comments and see what you have had to say. Please share, like, and subscribe. And please go to my Patreon account every once in a while and consider a contribution so I can keep all this going. Okay, I guess you weren't able to hear everything I said when I just shared the share, like, and subscribe screen because I don't have a microphone on that particular screen. But so anyway, if you could please share, like, and subscribe, and please go to the Patreon page since I've given you the link. Okay, in that, thank you very much for coming, and thank you very much for sharing. So I'm going to end the stream.